Hi, this is Leo Malmasi, and this is Forex Technical Analysis of the Euro USD for December 8, 2018. So, an overview, we're going to talk about market movers, support and resistance levels, market correlations, as well as some Bollinger Band analysis, and finally, some market forecasts and what positions you should be taking based off those forecasts. So, some terms for market movers could be smart money, stop hunters, or whale tracks, which is less common in Forex and more common in the stock market. So here's an example of a market mover where you can see that this market mover had a large sell order, whether they're entering the market or exiting the market, pushed the market far enough down that it either hit some buy orders down here or the economy pushed it back up, or one of the 9 central banks had tried to prevent some triangular arbitrage, pushing the market back up, where the market was still pretty strong going short, that the following day opened below the close. And often when there's a gap in the market likes to close it. So on this candle, the high is above the close, so it could have reversed at this point, though the market kept on going up before returning in the downward momentum of the market. Again, here's another market mover selling short, and here you can see a support and resistance level, where here it is a level of support before breaking through and becoming a level of resistance. And here this large investor had probably seen that, entering a short position, and this investor had such a large short position that the market had to move up, hit stop losses to fill that order before continuing and moving down into the market momentum. So now that we have defined, we can move on to support and resistance, where the market had moved up, hit a level of resistance, sharply moved away, and hit a level of support, struggling here, and then entering a trend channel before hitting again this level of resistance, struggling here for a short while, bouncing off the bottom of the trend channel, breaking through the level of resistance, and finding a new level of resistance, where at this point the market has struggled, started to enter a sideways market where it consolidated before finally having a breakout, going short, entering and finding this level of support once again that was defined over here. Though the market does kind of close below, close above it, so it is kind of oscillating around this level before eventually breaking through it. So to identify some correlations in the market, if you're looking for what time to trade during the day, out of 2,000 daily records, looking at days of the month versus time of the day, hours of the day. And just to be clear, this is Greenwich Mean Time, which is the most common broker server time. So according to your local time, you may have to add or minus according to Greenwich Mean Time. So here you can see the first 6 hours of the day are the slowest, as well as the last 6 hours of the day, which are not as slow but pretty slow. And then the middle 12 hours of the day, you have the highest volatility. So you have some pretty hot days here. And this one is most likely an common economic news event. And these, as well as the other warm ones, and these lighter warm ones are either some other significant news event, most likely. But if you're looking at the daily, weekly, or monthly to enter the market, these lower low volatility time is probably what you're looking at. And if you're an intraday trader placing multiple trades during the day, you're probably looking at this more volatile time of the day. So to zoom in, looking at days of the week, you you can see pretty similar pattern where the first 5 to 6 hours of the day are pretty slow on both the beginning and the end. Pretty slow for the first 6 and the last 6. And then this time it's the middle 10 hours of the day where it has higher volatility. So again, if you're looking at the daily, weekly, or monthly, you want to look at the lower volatility times to enter the market. And if you are looking at trying to enter the market for intraday trading, you want to trade during the heartbeat of the market, which is the middle of the day. So moving on to correlations for cross rates of the euro US dollar, I first want to define what the euro US actually and what the symbol actually means. So the euro is the base currency, and the quote is or the US dollar is the quote currency. And essentially what that means is how many euros can you buy with the US dollar. So that's what the exchange rate represents. So the correlations, correlated or cross rate currencies are the Swiss franc, the British pound, Japanese yen, Aussie dollar, New Zealand dollar, and the Canadian dollar. And here are representative of the base currency in correlation to the Swiss franc in this example, and the US dollar as the quote currency in correlation to the Swiss franc, and how this cross rate would be represented. So ideally, to get the cross rate, you want the base currency, target currency, and the target quote currency to be the numerator, and the cross rate currency to be the denominator. So in some cases, such as the British pound, you're going to have to use the reciprocal of this rate. So just to show, to simplify this equation of the euro franc over US franc, you can express it as the euro USD over the franc. And you have to do some conversion with the reciprocals highlighted in red. So the reason I'm using cross rates and why they work is because banks try to prevent triangular arbitrage, and I'm referring to the 9 central banks. So in the example below, with the franc, in this example, the franc is overvaluing the euro, but is not overvaluing the US dollar. So if you're a euro or a US investor, your base currency is most likely based in US dollars. So using the euro US, euro franc, and the US franc, you can create you can take advantage of a triangular arbitrage opportunity where you would buy euros, use those euros to buy francs, and use those francs to convert back to the US dollar, your account's base currency. So if the US franc overvalues the euro, you can place orders in this order in correlation to the symbol. Now you can do the same thing with the US dollar if the franc overvalues or undervalues either one. You just have to place the orders in the proper order. So what we're going to be using those cross rates for is to create our own Bollinger Band, but first we're going to look at a traditional Bollinger Band, where traditional Bollinger Band uses usually uses 20 historical candles to create their Bollinger Band. Where the cross rate, you can use the cross rates of the current candle just through different markets, which is going to make it a little bit more accurate. So here you can see Bollinger Band analysis, where the idea is that when the market reaches the upper limit of the band, you want to sell, and when it reaches the lower limit of the band, you want to buy. But you can see with the lower, the Bollinger Band, where these long boxes occur, you're most likely going to be losing money in the market. So in the long run, you're either going to end up with a small amount of profit or break even, or even just end up with a small amount of losses if you go long enough. So just to be clear, with the Bollinger Band, you can see here that it closes below the lower limit for a period of time. But if you look at that same time frame on the Bollinger Band used on a broker platform for Forex, it allows for more volatility, because the only time it actually breaks below within that time frame are these two candles, and every other time the market actually closes above this lower limit up until this point. So just to be clear as to the calculations for of a true Bollinger Band versus the Bollinger Band you would find on a broker platform. So here using a Bollinger Band based off the cross rates, and I made these aqua and magenta just to be annoying colors, to be very obvious as to which one is the upper limit and lower limit, because if you look at it without really focusing in on any one part, it looks like a lot of craziness, though the idea is that when it breaks above is the opportunity to sell, and when it breaks below is the opportunity to buy. So when, for example, this one, it can be difficult to see, but it breaks above and it breaks below. So this candle would be considered like an indecision candle. It's not saying to go long or short. So with this, you can see that the boxes are a lot smaller. There's one losing trade here, but in the long run, if you trade this pattern long enough, you're more likely to come out on top with profits than breaking even. So to move into the 1 month analysis, combining Bollinger Bands, traditional rolling Bollinger Bands with the cross rate Bollinger Bands, and applying support and resistance levels, this is where the market is currently sitting at, and it's right on top of a support level. And the most recent market entry signal was roughly 2.5 months ago. So also, if you look at waves of the market, which kind of be these bounds in the market, this bound in particular right here, the bound almost retraces 100% to the last high, which is an indication either reversal or entering a ranging market. Furthermore, the low here is higher than the last low, and the high is lower than the last high, which a lower high and a higher low always indicates market consolidation, which also kind of gives more evidence that the market is entering a ranging period. So my suggestion for the 1 month period is to hold your position. The market is most likely going to enter a ranging period. There's no evidence of short or long trends, meaning there's no lower lows and lower highs, and there's no higher highs and higher lows. And we saw that there is a higher low and a lower high, which is a consolidation pattern. We saw a near 100% retracement, indicating either a reversal or consolidation of the market. A loss of momentum, which if you go back, it loses momentum because it's no longer moving up or down, but rather moving sideways. And the exchange rate is currently sitting near a support level, as we saw here, which the support level, it could test this level again, or it could start moving away from it, or since it's entering consolidation, it could just as likely break through this level. And as we mentioned, it's entering consolidation period. Now looking at the 1 year time frame, where these dotted lines represent 1 year, we have this level of support back here, which had turned into a level of resistance that's not well respected, but was enough to move the market away from it. And we had also identified some level of support and some level of resistance as well. Level of resistance here, and then had become support here. Now the market, most recent market signal was to go short here and come down to to go short, and found a level of support here until it broke through and closed below. So now it's most likely that this level of support is now a level of resistance. And then the next level of support is way down here. So to move down here, we can see it roughly took less than a year, between 8 to 6 months. So we're looking at another 8 to 6 months to reach this level of support. So because we can't really tell what's going on, additionally we can see that the traditional rolling Bollinger Band is beginning to close, as well as the cross rate Bollinger Band is beginning to close up, which tends to show indecision in the market, as well as which leads to consolidation in the market. So again, I would suggest to hold. The market just broke through a support level, likely becoming a resistance level, as we saw. Level or low confidence in that the market is entering a ranging period, just because it did just break through this level of support, which it could come back and test and then sharply be rejected, or it could simply continue this downward trend, though the Bollinger Bands do indicate that the market volatility is slowing down, the market momentum is slowing down. And just as I said, this is also a low confidence short trend. And we had talked about how the both traditional and the cross rate Bollinger Bands are closing, showing that the market is beginning to consolidate. So here are the references. If you'd like to learn a little bit more about trends and consolidation patterns. Again, this is Leo Malmasi, and this was a technical analysis for the Euro USD on December 8, 2018.